All right, good morning, investors and traders. Hope everybody enjoyed a long extended Labor Day holiday weekend. But here we are on Tuesday, September 5th, 2023, and we're embarking upon a new trading week, a new trading month. There will be loads of economic data, a lot of financial media hyperbole, warnings, cautiousness that is embedded into your psyche over the course of September. Why? Because maybe you know this already, but September happens to be the worst month of the year for S&P 500 returns when compared to any other month of the calendar year. And this goes back to 1950. In fact, it's the only month whereby the S&P 500 on average has delivered a negative return. We often reference this kind of quantitative data as being seasonal, right? Seasonal data, seasonal patterns, historic occurrences in the market that tend to take place according to some degree of seasonality. What we're looking at in front of us right now is our research report from July 23rd entitled Seasonal Downturn Psychology. Well, Seth, July 23rd, today, September 5th. Why are you showing us this? Okay. Bad question. No, I'm only kidding. Even though I asked it, right? We knew that actually August was going to probably pull forward the usual seasonal downturn that happens in September. We had the belief that it would actually start in August rather than September, the September swoon as it's colloquialized. We thought it was going to happen in August. Lo and behold, so far so good, right? We were ahead of the game. The other question you might have is seasonality really that important? If I was asked the question, if I was asked that question, I would say, if you rank it on a scale of 1 to 10, I would rate it as a 5. Why as a 5? Mainly because seasonality by itself, right? From a practical investing standpoint, using seasonality, seasonal patterns to project future S&P 500 returns, often not the best way to go about making capital allocation decisions based on purely seasonal patterns. I often suggest that the savvy investor and trader pairs or juxtaposes that seasonal data with some kind of other technical or quantitative data sets. So that's why I say, is seasonality important? Yes, but where do I rank it on a scale of 1 to 10? Right in the middle, at a 5. I do think it's important, but I don't think it's the most important. And as I mentioned, I think it should be paired with other types of quantitative data. How important is seasonality? Well, if you think about just 2023 by itself, and you kind of remember what happened in 2022, which was a midterm election year, the 4-year presidential cycle tends to be what a majority of savvy investors and institutions model their projected S&P 500 forward performance off of, the 4-year presidential cycle. And just to kind of remind ourselves, that's exactly what we understood coming into 2023 and coming out of 2022's midterm election years. Midterm election years, which was last year, here's the 4 quarters of a midterm election year. And as we can see, this is the weak spot, Q2 and Q3. What was the weak spot last year? Q2 and Q3. Into early Q4, right? Because October 12th was the closing low for the S&P 500 and Nasdaq that year. But Q4, you do tend to have a better performance. We tend to trough in a midterm year. We tend to trough in October and then ramp the rest of the Q4. And that's pretty much what happened last year. Fast forward to what comes after a midterm election year, a pre-election year, or year 3 of a 4-year presidential election cycle. And year 3 happens to be the absolute sweet spot. That's where you want to make sure historically you have equity market exposure above and beyond possibly any other year within the 4-year presidential election cycle. Q1, the best year, the best quarter within the 4-year presidential election cycle. Q1 of the pre-election year is the best. Q2, very, very strong as well. Q3, not so much. Well, this year so far, kind of bucking the trend. I mean, July was a very strong month. August, a weak month. August, actually, we ended a 5-month win streak for the S&P 500 and Nasdaq. But Q4, like most years, right, whether it's a post-election year, midterm year, pre-election, or the election year itself, Q4 typically has good returns, right? You've heard the December or the Santa Claus rally, all that good stuff, the holiday shopping season. Stocks tend to do well in Q4. But going back to our original, focus topic here, year 3 or a pre-election year is the best time to own stocks, shy of the Q3 period being the worst period within the pre-election year. But we will be coming out of that Q3 period very shortly, obviously. This is the last month of the Q3 period in a pre-election year. And we do anticipate, Finom Group does anticipate a Q4 surge for stock prices. All right. So, again, having the right expectation of markets is also often a very, very sound principle when it comes to your investor psychology. So we had the right outlook. We had the right expectations for markets going into August. We titled this research report, Seasonal Downturn Psychology. More importantly, though, there was this, we had a lot of overbought conditions back in July that also favored pulling forward some of that September swoon effect into August. But there was one condition that we understood about the S&P 500 and the Nasdaq back then that suggested we would have a pullback sooner rather than later. We talked about the S&P 500 being more than 20% above its 200-day moving average. Typically, that is an area where you're going to get some consolidation, where you have overbought conditions. But we noticed the same thing in the Nasdaq, and I want to highlight this chart here. So what had happened was, as we articulated in our research report, as far as the Nasdaq overbought conditions combined with the seasonal data, first, there haven't been too many years for which the S&P 500 had gone from 20% below its 200-day moving average to 20% above its 200-day moving average, right? Last year in the bear market, the Nasdaq, the S&P 500 fell 20% below their 200-day moving average. Oversold. Fast forward to this year, both indices got 20% above their 200-day moving average. Overbought. And so we looked for the occurrences whereby this happened in the Nasdaq. You went from 20% below the 200-day moving average to 20% above the 200-day moving average. Going back to 1985, the only occurrences that we found were 1991 for the Nasdaq, 2003, and 2009. And one of the things that we focused on in this particular report, as we understood there was a probability for a pullback, because we want to know what to do with that pullback. Is it a buying opportunity, or is it something to shy away from because it's going to develop into something even more egregious for the indices? especially the Nasdaq carrying that much more beta than the other indices. But what we noticed was, look, in 2009, when you had this condition going from 20% below the 200-day moving average to 20% above the 200-day moving average, in 2009, here was July, up, up, and away. 2003, here was July, up, up, and away. 1991, here was July, up, up, and away. Right? So this was the fourth occurrence. This was the fourth time this kind of oversold to overbought condition had developed in the Nasdaq since 1985. So what we understood was, if there was going to be a pullback, it was probably a buyable opportunity for investors based on past precedents. But here's the other thing. We're going to fast forward to this past weekend's macro market research report to Finom Group members, September 3rd, just this past weekend. Sunday, we usually deliver our macro market research reports. They go out to all of our members. And by the way, if you're not subscribed, don't hesitate. Just get our macro market research reports, our state of the market videos, our third-party research throughout the course of the trading week. You can subscribe for as little as $14.99 a month. If you want our trade ideas, if you want our investment ideas throughout the year, if you want to join our Telegram chat community, as well as getting all of our research, $59.99 a month, cancel anytime. All right, back to our report. So using the same occurrences, right? Going back to the same charts, NASDAQ below the 200-day moving average by 20%, then rising 20% above its 200-day moving average. What we noticed was August in 1991, you had a pullback. 2003, August, pullback. 2009, August, a pullback. Now let's get even more in depth here and focus a little harder. This pullback here in early September did not get to the low of August pullback. No real pullback here, folks. Sideways choppy action, but again, the low from August marked the low through the year end in 1991. The low in August of 2003 marked the low through year end in 2003. 2009, the low in August marked the low through year end. History says oftentimes the one thing that is very consistent, all else considered unequal, right? Because the circumstances surrounding the market are always different. But human behavior is extremely repetitive. It's extremely repetitive, reacting to price. And what we see is that the pullback in August for each of these occurrences, using the conditionality of a 20% below the 200-day moving average to 20% above the 200-day moving average, the low point was the August pullback. There was no lower lows the rest of the year. And you say, Seth, well, that's one, that's twice, that's three times the lady. Now it's the fourth time, right? This is the fourth occurrence since 1985. Is that a big enough sample size? What I would argue is that type of rule of thumb or of thinking when it comes to statistical analysis and quantitative data, I get it, right? We want a more robust sample size. We don't dictate how many times these occur. We just don't. And let's remind ourselves also something that I reminded our Finom Group members of. We looked at the oversold conditions in the S&P 500 2 weeks ago. Right? We had been on a 3-week losing streak for the S&P, for the Nasdaq. 3-week losing streak got the McClellan oscillator in the S&P 500 down to -100. That's a deeply oversold condition. If we just look at a 4-year time period, only one time did the McClellan oscillator get to the negative 100 or greater, negative one, that's all circled here. Only one time did the S&P 500 not then rally 4% or greater. Only once. Again, we're only looking at 4 years, but only once. So what happened this time when it got down to negative 100 on the McClellan oscillator for the S&P? We rallied 4%. Like I said, you can want greater sample sizes till you're blue in the face. It's nothing you can do about them if they're just not there. So I get it, and we should be questioning a small sample size data. But in my opinion, when you have a small sample size, even though you have a 100% efficacy rate on the forward probabilities for the particular indices, their performance going forward, the best way to be skeptical or cautious about leaning into that probability is simply reduce your position size. See, for something like this, any dip in the Nasdaq, based on past precedents, I'm a buyer. I just might not buy as big as I usually do because the sample size is so small. Having said that, gun to head, if somebody said, well, Seth, do you think this is going to repeat? My answer is it has a high probability. What about a government shutdown? Again, the what ifs, the yeah buts. There's nothing, if you live your life that way, right? If you live your life that way, it's probably a less rewarding life. With that being said, I hope you enjoyed this brief video here, this really dynamic case study. And when the Nasdaq goes from 20% oversold or beneath the 200-day moving average to 20% above. Have a great trading week, everybody.